All right, today we are jumping right into the wild story of First Brands Group, an auto parts giant whose collapse sent absolute shockwaves through the financial world. Seriously, it's a crazy story about everyday products, billions in missing money, and a mystery that has Wall Street completely spooked. So let's start with just one number, $2.3 billion. That is the staggering amount that one single creditor claims just vanished. Poof, gone, into thin air. And the big question is, how does $2.3 billion just disappear? And really, that gets us to the core puzzle we're going to solve today. How on earth did a company that makes stuff you'd find in any garage, spark plugs, filters, wiper blades, end up at the center of a multi-billion-dollar panic on Wall Street? Let's dig in. Okay, so let's set the scene. This whole thing exploded in the fall of 2025. A bankruptcy filing dropped like an absolute bombshell, and it caught some of the biggest, smartest names in finance completely flat-footed. And here are the raw numbers, which are just insane. In September 2025, First Brands files for bankruptcy, and the paperwork reveals this giant financial black hole. The company admitted it owed somewhere between $10 and $50 billion, but it only had between $1 and $10 billion in assets. I mean, that gap is just massive. So how did we get here? To understand that, we've got to rewind the tape a bit. Because this crisis didn't start in some complicated Wall Street firm. Nope, it started with a seemingly classic American success story, built on products we all recognize. The whole thing was started back in 2013 by a guy named Patrick James. It began as a company called Crown Group, and it just grew and grew into this auto parts empire, mostly by buying up brands that you've definitely heard of. We're talking Fram filters, Trico wiper blades, Autolite spark plugs. I mean, these are household names. And this timeline really tells the tale of its explosive growth. I mean, just look at the rapid-fire acquisitions. By 2024, this thing was a beast. 26,000 employees, $5 billion in revenue a year. But, and this is the most important part, this entire expansion was basically paid for by borrowing insane amounts of money. The whole company was built on a mountain of debt. So now we get to the real heart of the mystery, because according to all the lawsuits and investigations popping up, that incredible growth wasn't just fueled by debt, it was allegedly powered by a totally fraudulent financial engine working secretly behind the scenes. Okay, to understand what went down, we need to know one key financial term. It's called factoring. It sounds complicated, but it's actually super common and pretty simple. Imagine you sell a bunch of stuff to a big retailer. They might take, 90 days to pay you, but you need cash now. So you sell that IOU, that invoice, to a finance company for a little less than what it's worth. You get your money right away, and the finance company collects the full payment later. Simple, right? Well, here is how that totally normal business practice was allegedly twisted into a massive fraud. According to a lawsuit filed by First Brands itself against its own founder, the company was just creating fake invoices, or they'd take a real one and inflate the value. Then they'd sell these phony invoices to financiers for billions in cash, and allegedly, that money was just diverted, leaving the finance companies with nothing but billions of dollars in worthless paper. And this slide right here perfectly illustrates the fatal flaw in their system. Normally, the end customer, let's say it's a big auto parts store, pays the finance company directly. It's clean, it's safe. But in the First Brands model, the customer paid First Brands, who was then supposed to pass that money along. That one little extra step created a huge vulnerability. It meant all the cash flowed through their own bank accounts first, which is exactly where billions of dollars are now missing. So where did the money go? Well, the company's own lawsuit against its founder, Patrick James, makes a pretty shocking claim. It says he secretly pilfered company assets to fund his family's lavish lifestyle. They're not mincing words. Pilfered. They're saying he stole it. And the lawsuit gets incredibly specific. These are not vague accusations. We are talking about a $23 million house in Malibu, $3 million just to rent a townhouse in New York, $500,000 for a private chef, $150,000 for a personal trainer. These details make the whole idea of financial fraud feel very, very real. So when this financial house of cards finally came crashing down, who got stuck with the bill? Well, this wasn't just a couple of small-time lenders. The fallout slammed some of the biggest and most respected names in global finance. Just take a look at this table. The numbers are mind-boggling. A joint venture involving Japan's Norinchukin Bank was on the hook for $1.75 billion.
Katsumi Global, $1.7 billion. A fund run by the investment bank Jefferies lost over $700 million. Even the Swiss banking giant UBS was exposed for more than $500 million. This was a true financial contagion.
And as you'd expect, the consequences came fast and furious. The U.S. Department of Justice immediately launched a federal criminal investigation. And just a few days later, on October 13th, the founder and CEO, Patrick James, he resigned. So why does the collapse of one company matter so much to the rest of us? Well, this quote from the credit rating agency Morningstar sums it up perfectly. They called this a real-world stress test for the entire system of trade finance. This isn't just about one company's alleged fraud anymore. It's about the fundamental trust that a huge part of our global economy is built on. And that leads us to the final, really unsettling question that bankers and investors all over the world are asking themselves right now. Was First Brands just a one-off disaster, or is it a sign of a much bigger, much uglier problem hiding in the shadows? You know, this quote from JP Morgan's CEO Jamie Dimon just captures the mood on Wall Street perfectly right now. Now, he wasn't talking about First Brands specifically, but the sentiment is exactly the same. It's the fear that this spectacular failure isn't an isolated event, but it's just the first cockroach you see scuttling out from under the fridge. And this whole mess has ignited a firestorm of debate about the private credit market. Now, to be clear, this wasn't technically a private credit failure. But the way First Brands got its money, all this opaque, off-the-books financing, it shares a lot of DNA with that world. And it has raised some serious red flags about who is actually checking the numbers in this booming $1.7 trillion corner of the financial system. And so that's the multi-billion-dollar question we're left with. Was the incredible implosion of First Brands just a singular, unbelievable case of alleged fraud? Or is it the first major crack in the dam, signaling that the entire private credit boom is way more fragile than anyone was willing to admit? Only time will tell.